Keep in mind it is important to validate that any expense stop used has a realistic and accurate starting point from which to benchmark future expense increases. If the expense stop is low due to oversight or fabrication, the tenant unknowingly risks being exposed to larger than anticipated year-end reconciliation invoices from the landlord. One major component in most gross leases is a provision that allows for an adjustment to the built-in operating expenses over the term. This means the expenses can be adjusted in future years if property taxes increase, for example. This is accomplished by using one of the following structures: expense stop or base year. An expense stop is a fixed amount, typically per square foot in a lease, where the tenant is responsible for all building operating expenses and taxes in excess of said amount. Expense stops many times benefit landlords by limiting exposure to operating expenses exceeding what was expected during a lease. Many landlords will incorporate some version of an expense stop into full-service leases, and it helps to protect their operating income. For example, when the property's expenses, commonly property taxes, increased over the life of a tenant's lease term, the landlord is then able to bill the tenant for those increases rather than absorb the cost on their own. This bill usually comes to the tenant at the end of the fiscal year and is also known as a reconciliation invoice.